Weekly paying dividend ETFs have been some of the most popular ETFs in the market. Who doesn't love getting a paycheck every single week? We have 56 of them with dozens of them coming out. Soon we're going to be having 100 of these ETFs. And we have them from popular providers such as Granite Shares, YieldMax, Defiance, and Roundhill. Now, today we're going to be going over a new groundbreaking ETF. This is going to be QLDY by Defiance ETFs, known as the Nasdaq-100 LightningSpread Income ETF. Now, it does say distribution frequency is monthly on this, and that's actually wrong, but this ETF and the LightningSpread ETF lineup is going to do something that no other ETF has done before, and that is actually going to be paying out 2 times every single week, which is absolutely insane to think about that we're at this point where weekly dividends weren't even a thing a few years ago, and now we have an ETF that is released paying out 2 times a week. Now we see QLDY is an actively managed ETF that seeks frequent income while maintaining the opportunity for indirect exposure to the performance of the Nasdaq-100 index, subject to a limit on potential investment gains. Now, it is going to sell call options, I believe. We'll actually go through the strategy down below. QLDY is the first ETF designed to make distributions twice weekly, aiming to deliver more frequent income than traditional income-focused ETFs. Now, I made a video before about a daily dividend ETF portfolio, and that is going to allow you to combine a bunch of weekly ETFs to get paid every single day. This one is actually going to help you with that achievement of getting daily dividends by paying out 2 times every single week. Now, what the fund strategy is going to do with the LightningSpread strategy is 2 approaches. So the first, it's going to have synthetic equity exposure through deep in the money call options on the Nasdaq-100 index, which is going to provide the participation in equity market performance. Now, this is not uncommon. It is going to be synthetic positions. It's not going to own the underlying Nasdaq-100 index directly. It's going to do that by leap options, which is going to be deep in the money call options with a long expiration date. And in order to generate that option premium, daily option premium is going to be generated through the systematic sale of 0 days to expiration, known as 0 DTE, put spreads, seeking to capture rapid time decay from short-dated options. And that's really how they are able to pay out twice weekly, because they're generating option premium every single day through these 0 days to expiry put spreads, which is a bullish position we want to keep in mind. And by blending these exposures, QLDY seeks to provide investors with consistent income opportunities along with measured equity participation. And they're doing that participation through that synthetic exposure. Now, the strategy is designed to balance potential growth and premium income while recognizing the risks of options trading and market volatility. Now, in my opinion, this looks like a strategy very similar to Roundhill's QDTE. If we take a look at QDTE from Roundhill ETFs, this is a 0 days to expiry ETF on the Nasdaq-100. It's going to be synthetic exposure, and it does seem like it's going to be pretty similar to the strategy, except the difference is to generate the premium, it's going to sell out of the money calls on the index, versus QLDY, it's going to sell put spreads. So it's going to be able to get a little bit more premium by doing a put spread. But in my opinion, it's going to come with a little bit more risk because you are using a spread. But for people who are purely income focused, this may be a good option for you guys. Now, the investment objective. So the fund's primary objective is, of course, to seek income. Most investors in these income funds are not really too concerned with capital appreciation, and while capital appreciation is nice, what we're really looking for is the NAV stability. We don't want something that continuously decays in price, because you have to constantly reinvest your distributions in order to stay ahead of the game. Now, the fund's secondary objective is to seek capital appreciation, and that is going to be because they have those long call options, which can have some capital appreciation in bull market rallies. Now, there's no guarantee that the fund's investment strategy will be properly implemented. This is a very new investment vehicle. Paying 2 times a week is something that no other ETF or stock has done before. So this is very interesting. It's very new. I'm personally very excited, but we do have to know there's going to be some risks involved. It's very new. We don't know the performance, and an investor may lose some or all of its investment. And while the ETF seeks to provide twice weekly income, there is no guarantee that it will do it. It will do its best to pay out twice, but there is no guarantee that it can. Now, if the distributions are made, it is likely that the distributions will vary significantly from one distribution to the next, which is very common for income-focused ETFs. It all depends on the implied volatility of the overall underlying, and that is going to be determining what distribution rate you're going to be getting. If we take a look at QLDY, it did have a starting price of about $50 per share, and it's been trading for about a few days now. It was released September 17, 2025. It did have some nice capital appreciation with the rally in the market, so it is good to see that it does have that upside potential, which a lot of investors in these income funds are looking for nowadays. You don't want to miss out on the capital gains with bull rallies. That's just not a good thing for the long term. And if you can, collecting income and having upside potential is the best of both worlds. Now, if we take a look at the prospectus for Defiance ETFs, we can see that we're going to be having a high expense ratio. The management fee is going to be 0.99%. The distribution fees, no distribution fees, but it's going to have acquired fund fees and expenses of 4%, other expenses 0.01%, for a total expense ratio of 1.04%. So a little bit higher than some other ETFs out there, but that is going to be the cost if you really want 2 times paid out weekly. It's going to need a little more actively managed, and that's just a little bit of a trade-off. But in my opinion, if this ETF performs well, then it could be offset by the gains. And we also want to note that they have 2 other LightningSpread ETFs on their way, which is going to be the S&P 500 Income ETF, SSOY, and we have one on the Russell 2000 Index, IJRY, which is a little bit hard to pronounce, but those are going to be coming out soon. And if you are interested in those indices and you're not a huge fan of the Nasdaq for whatever reason, then those may be some good alternatives. In my opinion, the Nasdaq-100 is perfect for these income ETFs because there is more volatility, as well as you're getting exposure to some of the top 100 tech companies in the United States. The S&P 500 is going to be my second best bet. You're getting the top 500 companies in the United States, but it is going to be a little less volatile, a little bit more stable. If you want more stability, the S&P 500 index is going to be your best bet. And the Russell 2000 is not bad, but I do think there's a little bit more risk involved with that ETF. And a lot of the other ETFs that are based on the Russell 2000 has not been performing as well as the Nasdaq-100 income ETFs. So QLDY honestly may be the best one of the 3, with SSOY being the second close winner. If we scroll down from the prospectus, we can see it does have a disclaimer of NAV erosion risk due to distributions. Now, when the fund makes a distribution, the fund's NAV will typically drop by the amount of the distribution on the related ex-dividend date. And that's not uncommon for any dividend-paying stock or ETF. The fund or stock is going to drop by the distribution amount on the ex-dividend date. That's just the nature of dividend-paying stocks or ETFs. And the repeated payment of distributions by the fund, if any, may significantly erode the fund's NAV and trading price over time. So you may, as a result, suffer significant losses to their investment. And this is pretty common for a lot of Defiance ETFs. If we go to the Defiance QQQY, which is the Nasdaq Target 30 Income ETF, we can see the trend is very clear. It does have significant quote unquote erosion where you're not really seeing any share price appreciation. Now, it did do pretty well from Liberation Day, which was April 1st, until now. It's been pretty stable. I'm not sure if they've done a strategy change to mitigate some of that losses, but it's been doing pretty well lately for the past few months. But prior to that, it really has been a staircase down, and that's not really what we want to see with this new ETF. Now, of course, if we're in a bear market, there's nothing we can do. It's a bullish position, and it will drop with the overall market. And in those cases, you can't really panic and say it's a bad ETF in those cases if the overall market drops, just because it is going to drop with the index itself. But we do want to note that there is risks with this ETF. It's very new. We don't know how it's going to perform in weak markets because it's using those put spreads. Maybe the losses may be a little bit bigger than normal, but we will have to wait and see over time how this ETF performs. In my opinion, I would recommend waiting a little bit to see the first few distributions, how it performs during some drops in the market before jumping right in. Unless you're a risk taker, of course, then just jump right in, but don't allocate too much money to a position in this ETF. It's way too new. We don't have any performance history, and we don't know the NAV stability over time or the consistency of distributions. Can it achieve 2 times a week distributions? We don't know yet, but in my opinion, I think they should have no problem doing that, but they do have in the disclaimer, it may not pay out 2 times a week, even though it's targeting it. Overall, this is a groundbreaking ETF in its distribution frequency. I think we're headed in the right direction. A lot of people want an ETF that pays out daily. I'm not sure if that's really possible. There's going to be a lot of hoops these ETF issuers have to go through, but 2 times a week is probably going to be more than enough for most people. 3 times a week would probably be the most optimal if it paid out like Monday, Wednesday, and Friday. I think a lot of people would be happy with that, but 2 times a week is the most frequent ETF distribution frequency we've ever had. This is groundbreaking. It's very exciting, and I can't wait for those other 2 LightningSpread ETFs to come out, as well as competitors coming out with some more frequent income ETFs. A lot of people don't like Defiance because it has some NAV erosion, but I think this is going to set the trend for some other ETF issuers to pay out more frequently in their ETFs, which is very exciting. Let me know down in the comments what your thoughts are on QLDY or these LightningSpread ETF lineups. Are you interested in it? Are you going to buy it? Let me know down below.